Welcome everybody to our webinar for today. This is a new webinar that we have never done before. So you're in for a treat. Going to learn a little bit more about how our auto trading works. This webinar is going to demystify a lot of the questions that our clients ask on a regular basis. So more than likely, you're going to have quite a few questions that you didn't know about that are going to be answered here this afternoon. Before we get into that, first, just the quick risk disclosure here. Trading involves substantial risk of loss and is not appropriate for all investors. Past performance may not be indicative of future results. So our presentation today is mainly focused around educating you about how our auto trading programs work, so that you can find out if auto trading is going to be a good fit for you moving forward. We've got a lot of uncertainty in the markets this year, and if 2023 is anything like 2022 is, you're probably going to want to be well aware of how to participate in the auto trading programs, because 2022 has been quite favorable for all of our auto trading programs. So we plan to go over lots of stuff today, which will hopefully get you in a position where you know what you need to know. So our topics that we're going to be going over: first, what is it? How does it work? We'll go over all of that information and then talk about the risk management aspect of auto trading, how InvestiQuant does that. We'll talk about funding the account and how to allocate, and then go over some best practices and mistakes that our clients make, as well as some due diligence questions that you may want to know before getting started. We'll finish up with some Q&A, and to participate in that Q&A, there's a button that you can push here in Zoom. You click on that button, type in your questions. I see the first question coming in right now. Will you send a recording of this presentation? Yes. Yes, if you're in here, you're going to get a copy of the recording. You'll get that tomorrow. So that'll be out tomorrow afternoon. This is not going to be like our other webinars that you may have seen last month, where we were talking about all the performance of each of the individual programs. We're not going to go over that stuff. We're not going to have a broker here today to talk about that or pricing. This is just going to be educational about how auto trading works. And it should be around an hour. We're going to try to keep it to an hour. So hopefully we'll be right on time. With that said, let me hand it over to Scott. He can get going, and that will get us to your questions as we get to the end of this. So go ahead and type in the Q&A section when you have those questions, and we will get to your questions at the end of this presentation. Scott, are you ready?
I am here. Thank you, Matt.
Great.
And let me share my video here briefly. Just want to say hi, everyone. And then I'm going to take it away. I'll spare you having to look at my mug for the next hour. So first, Matt just showed you where the Q&A button is on Zoom. If you look just to the right of it, you see a chat button. Anyone know what's special about today before we get started? Anyone? Somebody's got to know. We've got a nice sized crowd here. What is special about today, December 7th? I'm not going to continue until someone.
Bill has an answer here.
All right.
John, looks like we got several guys.
Did anybody get it right?
Yes.
All right. Pearl Harbor Day, December 7th, a day that will live in infamy. I'm not going to make any corny jokes about the loss of life and the analogies between people's accounts feeling bombed, but I do know that's the way a lot of people do feel, right? It's been a rough year for anyone that's got exposure to equities and really just about any type of asset. So you're in the right place if that's you. And the good news is we're not just a solution for helping protect portfolios when the markets are turbulent and troubled. We actually do really well when the markets move to the upside also. As long as there's volatility, we can make money in both directions. So you're in the right place. And I'm glad a few people knew a little bit about Pearl Harbor. You know, something I heard mentioned, just one quick note, I'm ex-military, as you know, but or may know, over 2,300 people died, military, in Pearl Harbor. So a staggering number. I really didn't realize it until recently, or I'd forgotten it. So I'm glad we remember that day, probably not as much as we should. All right, so what is IQ auto trading, or auto trading with intelligence, as we like to say? Well, it's your account, our strategies, and third-party or professional execution and oversight. And it's exactly like it reads. It is literally your account. You're not sending money to us. So I want to put it in context. And some of you have seen this slide. I've got lots of new content we're going to be sharing to answer questions. But it's important, if you're new to us, that you understand this basic concept. You have to have an account at an execution broker of ours. They're the ones that provide the execution and oversight. And that's a huge advantage for you and for us to have that third party involved. So it's that third party that enables our strategies literally to trade your account and my account and my IRA account and my parents' accounts and my friends and family accounts and hundreds of clients all at the exact same time. And none of us have to really worry about something going wrong or not working properly, because there's literally a third party registered fiduciary overseeing the whole process from start to finish each day. And that's IQ auto trading in a nutshell. We've had a tremendous year. That's probably why many of you are here. We have 4 programs, which we will, as Matt mentioned, we will not be talking about today. But through November, the worst performing one this year is up 23.5%. And the best performing on a percentage basis is 68.7%. And without really significant drawdowns either. That's, I guess, beauty's in the eye of the beholder. We'll talk about that, show details and discuss drawdowns and so on at our upcoming webinar next week. But today we won't be talking about that. We're going to be talking about everything else except for really the programs themselves in their performance. We're going to talk about how it all works. If you're like me, you have to really understand something before you can really appreciate it. Maybe the one exception for me is cars. I can enjoy a nice car without understanding exactly how the engine works. But a lot of people with auto trading, when you're dealing with money and risk, you really should understand, at least have a cursory understanding of sort of the mechanics of it all. So we'll be covering that and a whole lot more. So I thought I'd try something a little cartoonish, I guess, but just at the highest, from the highest perspective, right? Here's the big picture, and something that really, I think it's a good analogy. So bear with me in this simple analogy. But think of us as your favorite airline, if you have one. And our mission is to help you reach your desired destination. Our airplanes, in this case, are auto trading solutions, right? Designed for clients with different destinations, right? So some of you are here really interested in just taking a little bit of capital and growing it as aggressively as you can to take advantage of volatility. Nothing wrong with that. It's exactly how many of our clients use auto trading. Others of you don't want too aggressive returns because you know that the flip side of aggression is volatility in your account. And you just want diversification, quality and diversification to help protect and smooth the returns in your portfolio. So that's what we provide, but we do so with the help of that third party I mentioned. And in this case, think of the broker, the specialized execution brokers that we use as the air traffic controllers. Right, so they're going to help you make sure you get on the right plane. Right, the right plane for us is the right auto trading program for your risk tolerance, your funding level, and so on. And they're going to help you get onboarded completely, and also make sure that we have safe flight operations. Right, so they're literally overseeing with registered, trained, highly experienced traders overseeing the execution of our automated algorithms that are trading your account and everyone else's account simultaneously. So just like flying on an airplane, there might be some turbulence along the way, right? It might take you longer than you plan to get to your destination. And frankly, we can't even guarantee, if you bear with the analogy, we can't guarantee that you will reach your destination, right? And if God forbid, there are occasions where airplanes don't make it, right? And we can't give you a 100% guarantee that you're going to achieve your goal or your destinations either. But we have been a quality airline, if you will, for nearly 15 years. We started the company in 2008, and our friends and family, and as well as ourselves, ride on these very same planes and same flights as all of our clients. So we're all in it together, and that's what we do at the very, very highest level. Next slide, please. And by the way, feel free to post those questions. I see some already coming in. I'm not monitoring those questions. Matt will interrupt me if he feels like it's just something pressing that I should answer on that slide. Otherwise, we will hold them to the end. So let me really talk about what your responsibilities are and sort of the breakdown between us and the broker as well. Your responsibilities as shown here are very simple. You have to take the initiative to open an account at one of our approved execution brokers. We have a primary. We actually have a representative. One of the execs from the company will be with us next week to speak and answer questions about setting up accounts and their responsibility and all that. But you have to do that. We can't do that for you. And at the very end of the process, you have to also monitor your account balance. We can't do that for you, and the broker won't do that for you either. There's just simply too many accounts to do that. And in fact, we don't even have access to your account. We can't see your balance. We can't tell when it's funded. We can't make it trade. We don't even trade your account. Technically, we're literally executing signals, sending signals. And I'm going to show you that in a moment. The broker's highly involved, though, as I mentioned before. They're helping you set up your account. They're making sure your funds are held at a regulated custodian that specializes in futures. We are trading futures, which are derivatives of the U.S. S&P 500 specifically. So the S&P 500, we're just trading a leveraged version of it called futures. They'll help you get set up there. And then the broker's also helping with their trading team, overseeing, making sure that your account doesn't get kicked out due to margin, or if it does, to notify you. Make sure that the orders are executed properly at entry, and most importantly at exit, right? If you don't realize this, we are an intraday only algorithmic trading firm. We only day trade, literally. Many advantages. Big money doesn't like to get involved when they can't make enough money. But us small traders, right, we can take advantage of leverage and intraday volatility to do really well. So it's really sort of a perfect spot for us. The broker also helps with ensuring all the execution, make sure nothing ever goes wrong. And if it does, they correct it immediately. They also involve us getting statements to you. So you'll have daily statements, or all of our clients have daily statements along the way. And then our part, as you realize, we're just the strategy developers. And I don't say that lightly. We do the most important part, right? We're building the airplane that you're going to fly on. So we develop and maintain them, we monitor the markets, and we generate signals that ultimately get turned into trades into your account. Next slide, please. So I was thinking, and Matt and I were thinking just this morning, that we really need a slide to show how auto trading works, and realized that we didn't really know how to put it together simply, and it was going to be too ugly of a slide once we created a Google slide. So we asked our brilliant team of developers for someone to sketch out how it works, and Dave sketched it out in minutes, and this is literally what he sent us, and we thought it was perfect. So on the left, just at a very high level, we have sophisticated software that captures price data for price action, events. So think of in terms of, is it jobs report day, is CPI report day, is it the Fed day, and so on. We track, I don't know the exact number, but 30, 40, 50 different events. We also track a massive database of, the dev team calls them features, or I think of like factors or indicators, but over 750 different criteria that can describe a market condition. And they go into a massive database. So we track all that data every single day. And then we have a separate repository of our algorithms. Our algorithms are what utilize the data to identify if an attractive statistical edge is setting up that day that could be traded within our risk tolerances. And we have pattern-based algorithms or strategies, event-based strategies, and we have machine learning-based strategies and algorithms. So different sort of sources of edge, if you want to think of it that way, that do, whether it be mean reversion or momentum trades, longs or shorts, a whole host of different types of trades that can occur and do occur inside of clients' accounts. All these different potential trades get fed into another layer that's our program layer. And we have, as you know, 4 programs. And those programs take all those different strategies and feed it into our risk management algos. And our risk management will literally segment each program's strategies for the day another level to make sure that we don't exceed the daily risk budget, as we call it, for a given program, right? Because we just can't take unlimited risk every day, because we will blow up your accounts and our accounts. So we have to have a certain amount of maximum acceptable amount of risk that we're willing to wager, if you will, that day. And then once the risk management filter kicks in, what's left are just the signals that will be traded that day. And those are sent algorithmically, electronically, and literally in milliseconds from our signal server co-located with the exchange in Chicago, Illinois, where the futures are traded, directly to our brokers. The brokers are spread out, but our primary broker is in Chicago, to a piece of software they have that receives our signals and converts them into orders for a giant allocation account that trades hundreds of clients' accounts simultaneously with hundreds, potentially thousands of contracts at a time, where the results are then segmented into trades and allocated to each client account for each program. So obviously we have more than 3 client accounts, but they get separated at the end of the day, and they do something called, I always screw this up, it's either ASP or APS, but it's average price sold, I believe is the name of it, where basically they have algorithms on their end that make sure that every single client account got the exact same result. And that, my friends, is how auto trading works. Next slide, please.
Hey, Scott, one question here, which is probably relevant.
Sure.
Is the neutral network consistently incorporating new data and walking forward?
You broke up in the very first part of, is the what network?
Is the neutral network consistently incorporating new data, learning and walking forward with that new data?
Yes. So we'll get to that in a little bit, but I'll answer it at a high level. We have 2 generations of machine learning that drive and create the majority of all of our edges, the vast majority of all of our edges. They are, every day they're updated with current price action and review their own performance as well for the current market conditions, and always adapting. So if it doesn't meet performance criteria, it will not take the trade. So we used to, for example, our algos used to automatically generate many mean reversion strategies, where we go the opposite direction of the prevailing trend at the open. So if the market's rallying into the open, it'd often sell, or vice versa, it would buy, because that was a really good setup in certain scenarios. The algos would adapt, would identify that and execute those trades for us. But now we do actually more, this may have changed this past year, but at the end of last year, I know that we were doing more follow opportunities, where we were literally trading in the direction of the gap, because for the past 5 or 10 years, that bias that used to exist around 2005 to say 2012 changed to, as QE came on board and everything just was, all the buy programs were kicking in, and it just stopped working. So completely adapted. We didn't change a single thing on its own. And then with the machine learning, the 2nd generation that we do now, they are being retrained regularly with new data and creating new results on a regular basis. So very, very adaptive. That's the key. That's what we raised over $3 million for, frankly, from shareholders to build out that infrastructure. That's why we contracted with Duke Center for Quantitative Modeling to get their assistance. And I'm going back several years. This isn't new stuff either. We've been, 2nd generation, we just finished after a 2-year project, but the 1st generation was built in around 2013 through 2015. So yes, sorry for the long-winded answer, but it's a great question. And frankly, that's why I think our results are more consistent than most others, for sure, in the industry.
Hey, Scott, one more question while we're here that's relevant to this. I have someone asking, what is the risk management level? Maybe talk about that just a little bit more.
So actually, I'm going to go to the next slide. I think the next slide, or soon we get into the what we do for risk management. I can't remember which slide it is. Yeah, let me show you a trade, and then I'll get into risk management. Just hold that question just a minute or two. So believe it or not, there are actually investors that have never placed a trade or looked at a chart, really. They're buy and hold types. Some of you are here in the room. We're the opposite side of that. My life ambition was not to become a algorithmic day trader. That is exactly what I am now and what our firm does. So here's what a day trade looks like. These are 5-minute candlesticks representing price action on the S&P 500 E-mini futures. And you can see that vertical dotted line is the 9:30 a.m. Eastern time open. In this particular example, it's a real example from a year or two ago. We had 2 strategies go long. They risked, as you can see down below, the potential risk. One was $675, one was $737. That was meaning where their stops were down below. They went long. They survived that little dip at the open. First one hit its target, made just shy of $700. Second one held till near the end of the day and exited with almost double the profit. Now, this is not a typical day, but algorithms literally execute the trades at the entry and throughout the day, even adjusting stops after the open to adjust for context. We'll talk about that in a moment as well. And then exit out automatically by the end of the day. 99+% of the days, a human never gets involved, never touches anything on those trades. Probably more like 99.9%. Once in a blue moon, there might be a data feed or something that will goof something up, and we'll have the execution broker will say, whoops, it didn't close out, and they'll close it immediately. So, and I'm talking immediately. I can't remember last time we went past 4:01 Eastern time with the trade. So we just don't have many errors. We've been doing, these algorithms are all very stable. We've been running most of the strategies through our primary execution broker since 2016. So we're coming up on 7 years with the same strategies, believe it or not. What's changed is how we package them. And those are called programs. And it's taken us a while to sort of figure out the right balance of risk and return and funding level and so on. But that's where we are now. And again, as I mentioned, every single client gets the exact same results, including our own. We're all in the exact same basket. So risk management. Ultimately, a lot of people brag about how much money they make, and we're in this business for a number of reasons. So we certainly don't mind promoting and showing off our results either. But most people don't talk about the other side of it, right? The other side of it, to make money, you have to take risk. And if you have a tremendous year in returns, I hear that all the time from people that send us their examples of their strategies and so on. And that's great until you dig in and realize how much risk they were taking. So we do the best job we possibly can to minimize risk while maximizing returns. And we do it a number of ways. There's a daily risk budget for each program. So program is a collection of strategies. They're all trading the S&P 500 index futures with different types of strategies within them. So most of them are very diversified. But that whole program for the day has a max daily risk, the maximum that it will possibly lose in a single day. And that's first and foremost the way that we keep things from getting out of control if we catch a bad run or markets not conforming with historical biases or norms. So we have a daily risk budget. It varies anywhere from $1,500, I think our smallest program, the Meta program, up to I think it is $9,200 for our largest program. That's risk in a day. So you have to be able to handle at least a $1,500 risk. If you can't handle that, then we're probably not going to be a good fit for you. And that's in a single day. And the programs can lose more than that because we can have multiple successive losing days or a preponderance of losing days over a period of time. And you can lose more than that. We'll talk about that next week. But that's why I will say this, and maybe I should have said it before. If you're new by chance, you need at least $30,000 to start with. If not, no problem. Let us know. We do have friends in the industry, and that might be able to help you out. So the other way we manage risk is through diversification. As I mentioned, the portfolios are literally portfolios of multiple strategies with different stops and targets, different edges, and so on. And that helps reduce the risk, so we're not dependent on one single strategy, with sort of one exception noted. I guess Meta is a complete machine learning based strategy. It either goes long or short or does nothing. So it's going to be a little streakier long term, though it hasn't really been that way in live trading over the past year. Over the long term, will be a little bit more volatile, I believe. We use market orders. That's really important. We're not using limit orders to get out of the market. When we want to get out, when it's triggered and hit our max threshold, we want out, and we want out now. always 100% of the time when you're trading futures, that's the only way to go, in our opinion. You're just playing with fire if you use limit orders. It's a long shot. It's probably a 1 in 1,000, 1 in 10,000 these days, maybe even less odds than that. But if the market makes an aggressive move, and you don't want to be in a situation where your exit got skipped because you had a limit order requiring it to only fill you at a specific price. We don't do that. If it hits our level, we want out, we'll take the slippage, and we'll be out and be happy that we were out. We do have redundant monitoring. I have multiple members on our team are watching every single order. Remember, we're trading these things ourselves, but also the signals themselves, as well as the execution broker. They've got a team. We have no overnight risk. So by doing so, we're greatly minimizing our exposure to the market. And we're doing so, importantly, in that longer and less liquid period where you can get yourself in trouble sometimes and have lots of slippage and so on. So we never, ever take on overnight risk. That's why I argue all the time that we're safer than the stock market. Now, the brokers, if they were listening, they would say, you can't say that about futures and so on. But honestly, that's why we do what we do, because that's how I think about it. And we actually have risk off. Some of it's automated. Some of it is a manual override, which we can do if we ever need to. I think last time we did was years ago, but we can turn things off if there's some one-off risk event happening. Very, very rare. We do have some of the automated cutoffs that happen with ultra extreme volatility, but that's pretty rare as well. So because we've got this really sophisticated, fully automated algorithmic program that can identify edges and generate winning trades, as I showed you, that doesn't mean or show you really how you make money, right? That's making money on one trade isn't the key here. The key is to make money over a period of a year or longer. We believe you need at least a full year of trading activity to maximize the chance of having positive returns. We want every one of our clients to have positive returns. So that's why we require you to have at least a 1-year commitment to us. Odds are you won't take that long to make money, but sometimes it can. It just depends on, frankly, timing. And if you had good luck or bad luck with when you started with us, and the return stream. And we can't predict that, and nor can you. So over the course of a year is the way to think about it. And this is just one simple example. Meta's has traded less frequently this year. Sort of makes sense, right? It's been an incredibly unusual year. So we haven't had as many signals as the back testing suggested in other periods. We've had 69 trades in the first 11 months of the year. They've averaged a gain of $300. Now, it is a wide dispersion of gains. We've had trades make thousands of dollars. That's not uncommon with Meta. It is a home run hitting program. We've also lost, in Meta's case, up to $1,500 in a single day, because it does have that daily risk budget, a max cap of $1,500 that it can lose in a given day. And just to be clear, that does not account for commissions and slippage and exiting. So yes, technically it's probably lost $1,575 or something on a worst absolute day. But if you can average between your win rate, right, and your average gain versus your average loss, right, those are the three inputs into a concept called expectancy, or known in the trading world as average trade, which is what we're showing here of about $300 for the Meta program. Depending upon the combination of those variables, you can average out to only $300, even though you had these big gains and these big losses. It can average out to a very sizable number, and that's what Meta's done this year. So $300 spread over 70 trades is almost $21,000 in net gains for trading one single futures contract. So you can trade one single futures contract actually with day trading margin of less than $1,000, believe it or not. Now we're more conservative than that, and our broker is more conservative than that, and we add on top of that a large amount of cash funding that we suggest to give you lots of room to handle volatility. But literally, trading that one contract is made over $20,000. So that's how the math works, regardless of what type of strategy you might be looking at or considering. You don't really have to worry about that. That's the stuff that we worry about and obsess over regularly, right? That's the magic that has to happen. We have to have an a compelling positive expectancy, and it has to trade frequently enough to generate large enough gains to justify our effort and your expense, frankly. So, and just disclosure, it does not include, as it says there, the roughly 3K annual license fee of the meta. So you'd have to net that out. And if you'd been with us all year, you'd be up $16,000 or $17,000 roughly. So what is the source of the edge? So a common question we get in our other webinar that we'll be doing next week is, well, that's cool, you got these great returns, but I have no idea, really, how do you do that? Can you tell me a little bit more about it? So what we do, as I mentioned, we did raise over $3 million and spent a lot of development time and effort, and have spent it and continue to build it out, our infrastructure. It is not easy. In fact, this is the slide that I show people or talk about when people say, well, hey, why don't you just do this for yourself? Scott, why you share your signals? I couldn't do it. What we do is way too sophisticated. In order to get consistency, you have to do this level of complexity, in our opinion, because there's nothing that works all the time. So first and foremost, we trade only statistically based edges. These edges, almost all of them have been around for at least 5 years. Some have been around that we've been trading for since 2005, 2006 in my own account. So these are edges that are based upon something causative in nature, meaning something related to fear and greed, where the market's overbought or oversold, and we're opening at a technical level that is likely to maybe revert back to the mean. They're all fully automated, right? So we get rid of the risk that comes with emotions. Side note, if you haven't heard me tell the story before, at one point I tried to beat our algorithms 6 years in a row. I tried. And this is going way back to like 2010 through 2016, or maybe it was 2009, somewhere around there. I beat it, meaning I took our signal and manually executed our signals for 6 years, every one of them, and I beat it 1 year. And I'm not saying I'm a great trader, and I just proved it to you. I'm not, maybe in terms of a manual or it's called a discretionary trader, but I'm showing you how hard it is with emotions and knowledge. And I'm a very experienced trader, and I could not beat our algorithms trading purely what statistical edge suggested. So that's why we don't do it anymore. So everything's fully automated. It's all based upon known biases in the market, based upon really deep, intensive statistical analysis around these causative factors. And all of them, as I mentioned before, auto-adapt to changes in market volatility every single day. Some of our strategies are updating, our machine learning ones are updating every single minute, all automated, leading into the open to discern and confirm whether or not they're going to trade or not. And that's same with our filters that determine whether or not our event or pattern-based strategies are going to trigger in a day. They're literally using the second level there. The signal confirmation is our database of all these factors that are used with some advanced machine learning to develop, we call it a confirmation overlay. It has to confirm every single strategy on the left. And there are different ways of defining what that means, but at a minimum, it cannot go against a strong known statistical edge that we've identified with the advanced machine learning there in that second phase. And then that is what generates the signals that get converted to orders in your account, but it's not done yet because our algos are still evaluating market action. And a day may start off great. In fact, let's do a couple scenarios. A trade takes off to the upside. We're long and it just rips to the upside and we're up big, in first hour or 2 hours into the market. Our algos will recognize a way that the strategy is up, the account is up, and there's no reason needed to keep the stop where it was, and it will adjust and tighten the stops. So think like a trailing stop for you traders out there. Other times, it'll recognize the context of the market as, hey, this is not really a trend day, and it's just had a nice run off the open, and we might need to only tighten the stop a little bit or leave the stop completely alone because it's not over. It's going to be a volatile day before a trend develops. So very sophisticated work that happens there after the trade is executed in your account. All of it done algorithmically, automatic, nothing required by the broker. It's all happening behind the scenes in your account for you. And we're just trying to reduce the risk, right? Maximize our profits and reduce, try not to give back any more than we have to risk during the day. And when you do those three things, you have strong edges with signal confirmation from a third-party source like our massive database of with machine learning and trade management after the fact. That's how you get results like we've delivered this year. It's an awful lot. It doesn't work every time, every trade right, but that's why we have edge. Over time, we have edge, and it shows up statistically. Next slide, please.
All right, why don't you let me go through a couple of these questions, take a drink if you need to, and we'll give it back to you in just a moment. So here's a handful of common questions that we get from our clients. A lot of people want to know, can they actually go in there and manage the trades once the program's executed a trade? And that is not possible. In fact, you just heard Scott tell a little story there about how he tried to basically do that over the course of 6 years. And typically it only costs you money. So that is not something that you can do. Our programs are designed to run on their own and manage themselves. So it's not something where you can go in and adjust stops and targets. Another common question, can I trade in the same account? You can open a sub account under the name that your current auto trading account is in, but you cannot trade in that exact same account that the auto trading is in. We keep that separate, and that allows you to view your results separately as well. You won't get any trades intermingled in there and messing up your results. So the auto trading takes place in its own specific account. Now you can see your trades on a day-to-day basis. Every night you'll have access to a statement that you'll get an email saying your statement is available. You can go check it out. And that will tell you the trades that were taken for the day. You'll be able to see exactly where they entered and where they exited and what that amounted to. So the daily results will be there. You'll also get a monthly roundup of those trades as well. The monthly statement, which is what most people tend to focus on, is just kind of look at a month-to-month basis. But for those of you that need to see day-to-day activity, you will have a statement that will show you that. Another common question is futures trading risky? Well, all trading is risky. It doesn't matter what type of trading you're doing. All trading involves risk. I would argue that futures trading is not any riskier than any other form of trading the way that we do it. Every trade that we place has a stop attached to it. So every time we place a trade, we know where we're wrong and we're going to exit that trade if we are wrong. So we're going in each day with our strategies, knowing exactly where the uncle point is, and we execute quickly when that takes place. We also don't hold any trades overnight, and that can be a huge risk, especially for swing traders. Even trading stocks or whatever, you can hold overnight, and then you wake up to some sort of news announcement, and the market's moved 5% overnight. Well, that's not going to happen the way that we trade, because we're not taking on any position that will be holding overnight. So that is another way of getting rid of risk that common traders would have to address in their own trading plans that we don't have to worry about. So I don't see it being any riskier than any other form of trading, assuming that you're using good risk management. And Scott talked about our risk management early on. We take that very seriously, and we do all that we can to mitigate risk so that we're never going to be surprised. Can we guarantee returns? No. And quite frankly, if anybody is telling you they can guarantee returns, that should be a major red flag. We cannot guarantee returns. We can tell you what our programs have done historically. We can tell you what they're doing this year. And quite frankly, we expect our programs to continue to perform in line with how they have in the past, but we can't guarantee that. Nobody can guarantee that. There's no crystal ball in trading. So all we can do is trade along with our statistics, which tell us where to trade. And we expect that the future will most likely be like the past, but we can't guarantee that. And then, can I use my existing broker account? If you have an account with one of the brokers that we use, then the answer to that would be yes. If you don't, then you'll need to open an account at our executing broker. Our main executing broker is the Fox Group. They're based out of Chicago. We've been working with them for 6 years, and they do an excellent job at what they do. And the good news is, if you don't have an account with them already, it's pretty quick and easy to set up a new account. You can you can probably be up and running within the week if that's something that you're interested in doing.
Hey, Matt, if I can just add on real quickly, just one more thing back on that slide. Even if you are a fantastic trader, and we actually have a market wizard. If you're familiar with the market wizards, is one of our clients. Even if you're a fantastic trader and you could leverage our signal, it's not even allowed by the brokers and the FCMs because it opens up opportunities for further risk when we've got algorithms trading, thinking that you're in a position and you're not, and so on. So it's not an option. I know it's something that we get asked frequently, but it's just not something we can do or will do. All right, so let me power through some things here because I want to make sure we leave time for questions, and we have a bunch of questions already. Funding and portfolio allocation. So this is always sort of a tricky part for everyone. First and foremost, you need to get input from the broker. This is really the brokers who are registered that are allowed to really give individualized advice. We are not allowed to give individualized advice, and we will not. We can talk in broad strokes, and that's what I'm going to do right here. In general, these are best practices that we employ, as well as many of our best long-term clients. Don't try to time your initial allocation. What that means is if you have an opportunity to trade something or invest in something that has positive expectancy, then time is money. You want to get started as soon as you can. Now, that may sound self-serving, but my second bullet addresses that. You should not go all in either, in my opinion. You should spread your investments over multiple allocations over time. Let time be your friend, because you're opening yourself up just to too much risk, market timing risk, as it says on the right there, if you try to go all in at one time. Definitely consider adding to positions during your drawdowns. That's what our smartest, best clients do. That's what we do. I do and have added in run-ups, because you don't know when a run-up's going to end, and if you wait for a run-up to end, that can be a problem as well. But one key thing is to not pass on drawdowns, thinking, oh, geez, the program's not working. Maybe I need to reduce my size. I can tell you, we manage money for Paul Tudor Jones, if you've heard of him, one of the world's most famous traders. His right-hand man, his quant, was one of our clients for a couple of years, and he did this masterfully with us. He would add greatly increased. I think he actually tripled his position, his initial position, on a drawdown after he first started with us. So that's the way the pros do it. We don't do compounding automatically for you. It's just the way it doesn't work with futures that way. We can't trade a partial contract. But so to achieve compounding of your returns, which is not required, but if your account grows, what most of our clients do is they add, once it reaches a certain threshold, enough funding to handle another, we call them units, another allocation unit, then they will add another unit. And that's how you can get compounding of returns, meaning grow your account even faster than the numbers that we show you in performance. Not required. We actually have clients as well that will take money out of their accounts after they achieve certain targets. Whatever you want to do is up to you. It's your account. So a couple quick mistakes I want to make sure you don't do. Don't micromanage your returns with account pauses. We typically, in fact, technically, I'm not sure we say anywhere that we will agree to do account pauses, but if you get in a situation where you're in a real bind, or you're going to be gone for 6 months, or there's a health issue, we certainly will work with you to pause your account. But in general, we don't offer account pauses, but you can pause the trading of your account by the broker. Remember, it's your account. So you're just going to mess up your returns more 99 times out of 100, I promise. You cannot time these returns. There is a randomness to return streams, all return streams, including ours. And if I knew when we were going to have the good months and when we weren't going to have good months, I probably wouldn't be talking to you. Okay. It's just impossible, guys. And then, we do require you stick with us for a year, as I mentioned before. So, getting into a drawdown right off the bat, which would be rotten luck. But if it happens to you, don't panic. It's all part of the ebb and flow. And you just take the long view, and you'll probably be very, very happy that you did. Some other best practices and mistakes people make. Best practice is to monitor monthly statements. Matt mentioned you can monitor daily statements, but what's the point? What are you going to learn? You're not, look at the first few if you want to feel better about how things are trading. but really just monitor them from time to time. If there's anything major, the broker's going to notify you, right? But in general, it's read our monthly updates. I probably should have put that here as well. Monitor your statements, maybe weekly. I don't know the right time. So in my mind, monthly is about right. Make sure when you start with us, if you start with us, we're not for everyone, by the way. If you start with it, make sure you know your uncle point where it's really 2 points, a pause point and an uncle point. There ought to be a point where you're like, whoa, what's going on? We've hit a drawdown. That's a reduction in your account value. That's concerning to you. That's your number. It's between you and your account. And then reach out to us. We're very, very reachable. We work really hard. We like engaging with clients. We respond to emails very quickly, and we will absolutely talk through what's going on in the market the best we can. But you also have to have an uncle point to protect yourself. So like all good investments, you have to know where you're going to get out no matter what. That's how you protect yourself from getting wrapped up in your ambition, your goals, your overconfidence in us, right? We tend to, I think, generate a lot of client confidence, and you should, because we work really hard and we're good at what we do, but there's no guarantees in life. So know your uncle point. Focus on the long term I mentioned before. Don't get upset by short-term swings in account performance. These are volatile programs. It's the random nature of returns. It really has way less to do about the strategies and how they're performing than what the market's doing. Are there outside market participants doing things that they haven't typically done in a particular scenario? Maybe you got some liquidation from some big fund or something. It can throw performance off for a day or two or three. So don't react to it, and that means the results will flip in a day or two or three of different trades that don't hold up, don't act the way they traditionally have done, is enough to flip a winning month into a losing month and vice versa. So keep that in mind. And I just explained why the results are not going to be consistent month to month. They ebb and flow in ways that are just 100% unpredictable. And I think I covered the account pauses. Next slide, please. So common due diligence questions. We're getting close to the end here, so we can open it up to questions. And we get a bunch of them, actually, especially from the larger investors and family offices and so on. But we do have redundancy across the board. Every position operationally in our company can be handled by another person. So if that person got hit by a bus or got sick, operations would continue without their involvement. We're also redundant at the, Matt can do my job, I can do Matt's job at the research level, at the sales and marketing level, and so on. We have redundancy in cloud-based execution. Amazon, we use Amazon. We have power supply backup for trade operations as well. We do have occasional hurricanes that hit us in North Carolina. We are well capitalized. We're a profitable business. We have shareholder support available if needed. As I mentioned, we raised over $3 million from a fairly significant number of shareholders, professional investors, and clients. It was about half and half. So we do have access to lots of funding if we ever need it. Dave and I were both Series 3 qualified, registered and qualified. That's a commodity and futures trading license. We're not current, but we did pass that test on our first try. And if you've taken it, that in itself, it's not an easy test. But we were also registered, passed the NFA and CFTC, that's the Commodity Futures Trading Commission background checks back in 2018. We're no longer registered because we don't need to be with this business model. It didn't help us get to bigger money. We realized once we got into it that in order to really attract some of the larger investors, we needed a 3-year track record. That was a long time to deal with a lot of regulatory headaches. And we also realized that our break-even point, with all this cost and time involved with being registered, just weren't worth it. It was going to take us longer to raise the hurdle of being a profitable business. So we're no longer registered, very thankfully so. But we still do everything, to my knowledge, just as if we were registered, very, very in line with best practices that we learned when we were registered. And then lastly, we do have all of our employees either have direct exposure, they're participating in the program, so they have indirect exposure through a company fund that trades these same strategies as well. Let's see, I think I answered by going down that checklist on the right. Oh, I didn't answer the top one. Do IQ employees have access to your account or funds? No, We do not. You send money to the broker and the custodian. It's called FCM, Futures Commission Merchant. We do not have access to your funds. No one can steal your money and run off to the Bahamas. Returns are no longer audited. When we were registered, they were. We don't need to be have them audited anymore, especially now that every client, literally we're trading these big block allocation accounts and everyone's getting the same results. So you can literally contact the broker by phone or email, and they will verify that the published returns that we have shown on our website are exactly what they say they are. You can even see an individual broker statement if you want, or multiple broker statements if you want to go to that level of due diligence. And if you want us to get audited, if you'll pay for it, I'm happy to send off account statements and get them audited for you. Let's see. I think I answered all those other questions. Next slide, please. I believe this is this last slide or next to last slide. This is probably the one salesy. It's a little bit salesy just by comparison of different features of our solution, the VestaQuant approach. And our business model, by the way, is called a letter of direction business model. That's what you authorize, that is you, the client, authorize the broker to execute our programs, our algorithmic programs in your account, along with everyone else's account the exact same way. So that's letter of direction business model. We are definitely hedge fund quality in terms of, in our opinion, and the investment and the sophistication of what we do. But there's a lot of downsides of putting money into hedge funds. Most of them, namely, are not. Most of them are correlated with equities, frankly, and they don't serve as a nice hedge. Hedge funds, many of them have struggled this year. If you look at the 600 top hedge funds, not done well. They also have high performance fees, high performance levels, or I should say funding levels. So you have to put at least $500,000 to $1 million. You lose access and control of your funds. You can't redeem and get access to your funds as quickly as you want. I've been in hedge funds, so I'm not just making this up. I've had significant capital tied up in hedge funds, and it really sucks when you want to get 6 figures out of a fund and for whatever reason, and you can't get it out. You have to wait till the quarter ends, or it does. So and most of them aren't automated and so on. And you can go down the checklist yourself. The other thing that's important to know, there's another category called commodity trading advisors. That's what we were. They can trade commodities and index futures and so on. There's also commodity pool operators, which operate with commodities as well, which is really just a form of a hedge fund. Some CTAs, when we were CTA, you did have visibility and access to your funds. That's the good news. And you could get out of the fund very quickly. So we did offer that. Minimum funding levels are larger. I think our bread and butter fund was a 500K program back then. So it's just the nature of the beast. And there's many other, you just have to dig into those other points with an individual CTA. But namely, you're just not going to find many that do intraday only, algorithmically only, if any. And if you do find them, they probably aren't profitable. The ones I've looked at several, I'm aware of that are not profitable this year. So do your due diligence. This is a good checklist you can go down, and it's obviously very biased with my view, but I do believe everything I've shared is accurate and honest there. I think this is the last slide. Where are clients from? They're from all over. We get this question all the time. That's another beautiful thing about our broker and our FCMs or brokers. We can serve and support you just about any country in the world. I'm not sure there's any we haven't been able to support. So there's a sampling of countries right there from all over the place. So that's the good news. The broker helps you with that, not us. If you're interested in learning more, make sure you come to the webinar next week. Time for questions. Matt, I'm gonna let you handle a couple of the softballs if you can while I get a drink of water.
Okay, we've got a huge list of them here. If you guys have questions, now is your time to type them into the Q&A button. Click that, type in what you want, and we'll do our best.
Hey, Matt, just trying to think, we should try to prioritize these two and maybe not go much longer than an hour, 15 minutes. Probably should have talked about this, but I see there's 33 questions. So,
okay.
And your call on how you want to manage it. If you think it's worth going longer, we got people still here. We still have a lot of people in the webinar right now. We can go longer. I can go longer to 6. I just certainly don't want to go more than another half hour just for the sake of the
Let me see what I can knock out quickly, and then we'll go here. All right. First question: do you trade options? We are not trading options. We are trading the S&P futures exclusively. Next question is asking about a list of our brokers. We're working with the Fox Group primarily. They are based out of Chicago. So that is where we are primarily sending people. We have another broker that we can work with that's white labeled some of our stuff. If you live in certain countries that we need to set that up with, we will send you there. But we primarily work with the Fox Group. We do not work with TD Ameritrade or Schwab. None of those are, either of those are available. Our brokers are excellent. So anyone that we send you to is because we have experience with them and they do a great job. So I don't know that there's a benefit of our white labeled broker versus our Fox Group, who we send you guys to. There's no real difference between them. They both do great work. But
and Matt, if I can add real quickly, we don't work with some of the bigger names that you guys may know because it does require specialized, if I can pardon the original analogy, air traffic control, right? You don't want just a vanilla large brokerage overseeing these trades. We would never let that happen. These are algorithmic trades. They need to be handled differently. We're using futures and leverage, and you need specialized expertise to do that.
Right, exactly. Next one here from Rick. Nice in and out today for a nice 1450 in profit and trader. Yeah, good trade today. 1450 in 15 minutes. They don't always work that well, but today it did. Next question from Bill. Does the broker support one single large block trade? Bill, the way the orders work is they do go out in blocks. Of course, there's multiple strategies. So we're not sending, if we had 1,000 contracts to trade today, we're not just sending them all in one block. They are getting kind of split up. So we get better executions. But every strategy will send an order out, and then those orders get allocated to the accounts of the individuals and averaged out that way. So everybody's ending up with the exact same trades, the exact same results. Next question from David. What percentage of trades get stopped out? David, that's going to depend on the program that you're in. Our meta program has the lowest win rate to it, and it's going to be somewhere in the mid 40% win rate. Some of the other strategies within the bigger programs have some higher win rates that may get closer to 70%. But it just kind of depends on what strategies being traded for the day. But they range in there somewhere from mid 40s to 70, maybe a little bit better than 70. But I don't know that we have anything in like the 80% range. That would be pretty rare to see something quite that strong. And the ones that have the lower win rates tend to have the bigger profits. So they're making more on their wins than their losses. And it kind of goes vice versa. You get closer to like a 1-to-1 risk reward ratio on some of the higher win rate strategies. Is it right that you only trade the ES and no other types of contracts? Why is that? Yes, we specialize in the ES. We are specialists. So we have a lot of experience with that. That contract has a lot of liquidity, and it's something that we have studied for decades. So we know our best markets, and the S&P is one of our best markets. We do trade other index futures as well, but we primarily trade the ES.
Hey, Matt, if I can add, our largest program, Select, can handle the diversification. So we do trade other markets in that program.
All right, let me give you this one, Scott. This is coming from Eric. Do you anticipate any changes to IQ's performance or strategies based upon changing market conditions next year?
I anticipate market conditions will change next year because they're always changing. And how our performance plays out is completely unpredictable. I know that's not an answer people want to hear, but I'm not going to lie to you and say, oh yeah, I'm confident, 100% confident we're going to kill it next year too. I'm very confident we're going to have a good year because we've got volatility, and that's the key. But when there are changes in market environments, yeah, there can be hiccups, but a hiccup's like a bad month or two. It varies year to year. I don't anticipate problems, but there are adjustments, and that's okay. They're designed to do that. That's the good news. So that's again why you should never try to pause and try to time it yourself. You will not be able to predict it. Trust me. Some of our best months occur after the worst months. And that's typically because the market's volatile and people get faked out. We've had a number of people over the years, and they're on our client wall of shame, where they closed out after we had one of those big, ugly months. If you look in the performance returns, where maybe it lost 10% or 12% or whatever in a month, and the client says, okay, I'm out of here. And of course, we reversed and made 18 or 20% the next month. They're just very fluid.
All right. Next question. I think I just answered this one. Is a typical strategy win rate greater than 40% over a 1-year period? The answer to that would be yes. I don't know that we have anything under 40%, but they do ebb and flow. It's not like it couldn't go a little below 40%. If it did, it probably wouldn't be for long, because those tend to stay higher on average. Next question: based on 30,000 in funding minus the $2,900 license fee equals a 59% ROI. Okay, that's comment about Meta. After the license fee, it would be up 59%. That sounds right. Next question. This is coming from AK. What is the max drawdown we should expect on one E-mini contract? So I guess he's probably referring to the Meta program specifically. Scott, do you want to talk about that stuff today, or should we?
Well, just high level, bit of a teaser. The max month-to-month drawdown off the top of my head in Meta is around $7,500 on a 30K funded account. That's just a month-to-month drawdown. It can be bigger. It will be bigger at some point in the future. That's the golden rule of trading.
Yeah, and we're going to get into all those type of specifics next week as well. We're going to do another webinar next week, and we'll go over all those performance metrics. Brian is asking, is there a chance your machine learning automation could go haywire and blow up my account?
No, there's not. It's a fair question. We get that once in a while. And here's why. So, machine learning is a form of artificial intelligence, right? And people hear that and they get all freaky about it. And I certainly understand it, and it inappropriately so, depending upon how it's applied. We use it for signal identification, not signal generation. Big difference. So we're using machine learning, which is really just super sophisticated statistical modeling. That's really what all machine learning is, in a nutshell, to identify edges and signals. But when it comes to execution, if you go back to that hand-drawn process map, it shows that once the signals are generated, it has to go through this program layer and risk layer before it gets culled down to and delivered in a very mechanical, traditional software type of execution process. So no, absolutely no chance. Thanks for the question, though.
All right. Next question. This one's from an anonymous attendee. Do you have audited returns? If not, how can I verify your performance?
As I mentioned before, we used to, and we did fairly well. We don't now because we just don't need it. The easiest way, people used to contact me, and I'd pull up my brokerage accounts and you could look at them. The easiest, fastest way for everyone now is to contact our broker, and they will respond, and depending on what level of granularity you want to go into, because they've got access not only to my account, but everyone else's account. And that's probably the biggest reason to talk to the broker. Have them verify that statement. They'll tell you that, yep, everybody gets the same thing. So they can look up any of our client accounts for a given program and verify the returns are the same as what we publish on our website.
All right, next question from Bill. Similar to your max daily loss, do you have a daily profit target where if hit, all algos stop trading for the day? I
don't mean to tie emotion to this, Bill, but absolutely not. I know that's more of a philosophical question that some people feel strongly about. I don't think that makes sense personally. That has never worked for me. we have predetermined algos that have predetermined targets or exits, right? Those exits are statistically derived. So that is what we're going to trade, and we're going to follow the model. The only time it'll vary from that is if post-entry trade management algorithm identifies that the context of the market and the price structure for the day is suggesting that maybe you should take profits prematurely, but that is extremely rare. Most of the time, we are better served by letting the trades play out and simply tightening, having the algos tighten the stops to reduce risk and lock in profits.
All right. Next question from Chris. Is the auto account profit treated as 60-40? 60% profits taxed at long-term, 40% as short-term for capital gains. Yes, that is the way it works because we are trading futures contracts. Here's one asking about the differences between each of the 4 programs. You want to do that next week, Scott? Or
yeah,
okay.
But let me give the span of it range from funding level of 30K to funding level of up to 250K. If you have more than that, which we have many clients that do, you can piecemeal different programs together or license multiple units of the same program. But they all have different return profiles, risk tolerances, and so on. So, and the information is on our website if you request access to performance and pricing, if you don't want to wait till next week.
A general rule of thumb there, the bigger it goes, the more diversified it gets.
Yep.
Next question, can I do a IRA 401k rollover account? Yes, that should not be an issue. And we'll have a broker on probably next week, which will be able to tell you any specifics about that, but that's usually not an issue. A large portion of our clients use IRA accounts.
And we're not suggesting that you do that, but I do it personally. And both of my parents' IRAs, if that matters, do it as well. So again, not a recommendation, but I think it does speak to our confidence in what we do in other clients as well.
All right, another question here coming from an anonymous attendee. Do you refine the algorithms and code? If yes, how do you test to verify there is no mishap?
So everything we trade has been traded. We traded in our own accounts, live trading. First and foremost, we're doing once it trades live in our accounts and has performed as described, then we have no problem putting it into operation. So I guess that's probably the simplest answer. I know Dave would probably love for me to elaborate further, but it's too much. So yes, we have a very rigorous process. Everything has been traded, has been tested and verified, and everything's monitored very closely for any potential problems, because there's always a chance there's a mistake or something that's been missed.
Next question. Event and fundamental news impact prior or in between the trades. So what's that?
I can handle that, Matt.
Okay.
Just assuming I'm understanding the question. Yes, so events that happen intraday can actually trigger price action that was unexpected and stop out a winning trade. More times than not, they will trigger price action that result in the trade becoming a winner. We have found news days do not throw off the average historical win for our setups. That's not what we have found historically, though they can be a catalyst on a given day. They can also set up trade opportunities for obviously the next day. So, but in general, the programs will trade with the news planned into their algorithm. So for example, a Fed day, the Fed days do account for that volatility, and we will hold trades through Fed announcement, because again, more times than not, they will become a winner, but sometimes we'll get stopped out.
All right. Let's see. Next question. Do I have to decide on the allocation, or will the broker do that on your behalf? So you need to decide which program you want to participate in. Once you decide that and you license it, The broker will do all of the trading on your behalf, but you make the decision of what you want to trade. So you'll pick the program, open the account, fund it, and then the broker trades the program for you. Next question from John. There's a 30K minimum for Meta. Can I fund it over several months, or must you fully fund it on day one? You must fully fund it on day one. It will need a minimum funding amount to be able to trade. Here's one from Rick. Let's give this to Scott. I have never heard this discussed in any of your webinars, but a retiree may want to consider extracting annual profits, say money above the 80,000 if one is trading a combo, and use this as an annual income stream. What do you think about that?
Yeah, there's nothing wrong with doing that. We've got one of our longest time clients has historically for a decade plus, you know who I'm thinking about, Matt Wayne, right? Has pulled profits from his trading account. And he's joked that we funded all of his vacations for many years. So nothing wrong with that. You can either pull the funds or roll it into, let them accrue and try to compound your returns.
All right, next question from Chris. Is the broker mentioned in here a company or a person? If it's a person, how do I get a broker? We work with a brokerage company. So the Fox Group is who we work with. They have several employees. Mainly we're working with Trent and Ryan, but they either one of those guys would be able to help you and get you set up. And you can contact me. My email is matt@investaquant.com, or you can send it to that info@investaquant.com if you need help with that.
And they'll have a representative. I'm not sure which one is speaking next week, but they'll be on the call next week. And they, like I said, they do have a team. They've been around for multiple decades, second generation. Even the son runs the company now, Ryan. He's excellent.
All right, next question. Are we going to get a tax form like a 1099 at the end of the year to report taxes? The answer to that is yes. You will get a tax form in January, which is pretty simple for futures taxes. So that will show up to all who participate. Next question from Alfred. Is your broker an IRA custodian? The broker we work with is not a custodian themselves, but they work with another custodian to get your account set up and trading. So you'll need to go through a custodian. Most of our clients use Midland. There are some others as well, but that's the one that's generally used, and our broker can help arrange the setup of that.
They are excellent. I will say that mine is not with them. It's with a firm called Millennium. Incredibly slow support. I would not recommend them. I don't blast companies publicly, but they're just incredibly slow. What takes Midland 1 or 2 days takes 3 or 4 weeks with Millennium. I've told them that for years and they haven't changed. So I put my parents in, they open up theirs with Midland and they're thrilled. Seriously.
Next question coming from David. He's asking, to get started, do we just contact Fox Group to open the accounts, and do they use Gain Capital? To get started, there's this link down here at the bottom. So investaquant.com/getting-started. This is where you'll go to get started. You'll license the program that you want from there. And once you do that, we take your information and we share that with the Fox Group. And then the Fox Group will reach out to you with the information needed to open the account. So if you're wanting to get started, you go to investaquant.com/getting-started and you license the program that you want. From there, you'll be contacted by the brokers to open the account. And they use StoneX, which acquired Gain Capital last year sometime. How much in percentage has the total account size grown since last year with the performance, or how would the performance through slippage, commissions, etc.? All of our performance is posted. I'm going to put a link on here where you can look at that. We track live results. So that includes slippage, that includes commissions, all of that sort of information is included there. In our programs, all of our programs in 2022 are up. I think Trader after today is up a little over 25%. And I think that's the lowest return for the year to date out of any of them. And the highest one is currently Meta. It's up around 69% year to date. But it just kind of varies by program, and can't guarantee which one will have the best performance next year. No way of knowing that, but that's the way they've played out this year. Next question. Could the Autotrade account be an IRA or Roth IRA type of account? The answer to that is yes. That is an option. Next question. What is the max drawdown we should expect? I think Scott already answered that with Meta. The max month-to-month drawdown on that was around $7,500. We'll go into more detail on that next week, but drawdowns will kind of vary by the program that you're in. The Meta program is a 1 E-mini contract program, so that one's $7,600, something like that on a month-to-month basis. Next question, Alfred. How many orders per day are they executed at the open? You want to take that, Scott?
Does he mean how many contracts, how many strategies? If you can clarify, we can.
I'm going to guess how many contracts.
So as we mentioned before, every strategy has a different timestamp and entry, and sometimes we'll have multiple strategies triggering around the open. So it'll be up to the maximum number of contracts traded in a day will be tied to maximum number of clients in that program. And our largest program has hundreds of clients, and I'll just leave it at that. We do monitor, though, to make sure there's not a performance impact. And at some point, we will, all of these are capacity constrained. We will close the programs to future accounts and only reserve additional capacity for existing clients. So at some point that will happen. My guess is we would roll out another program or have another program to offer, but you would be starting with something a little newer at that point.
All right. Next question. Can you share how big is the team in terms of headcount to help us gauge the team behind the infrastructure and redundancy?
Yep, we've got 8 total on our team.
Next question. This one's for Scott about your uncle points. Can you elaborate considerations, perhaps using 1 unit of Meta as an example for context, uncle points and pause points?
Yeah, this is getting close to giving advice. So I don't want to give advice, but think of it this way. It takes 1 contract, it trades 1 contract. So minimum margin is really not an issue here. So the 30K is really meant to give enough room to allow the program to trade without running out of capital. Can't imagine it would lose 30K. The way I do it, these are rules of thumb, and it's always going to be bigger in the future, is take 2 times the biggest drawdown in the past, and that becomes a good target point, reasonable target point for what to expect roughly in a more or less worst case scenario. So at a minimum, I'd make a pause point, something like 1.5 or 2 times the worst drawdown. So in Meta's case, 12.5 to 15K. Pause, see what's going on, because it's starting to get a little nerve-wracking, right? If you started with 30K and you're down 12K, and if you have the unfortunate luck of that happens right off the bat, which it could happen, right? Then you need to make sure everything's good to go. But I can't speak to an uncle point is really how much some people, 30K is all risk capital for them.
All right, thank you. Next question is InvestiQuant developing new auto trading programs. For example, you just added IQ Select.
We have a research component because as many of you know, we have a really powerful interactive backtesting research platform that we use internally and license to other professional traders and some retail traders as well. Yes, we're always developing new strategies and developing new programs because, as I mentioned, everything does have a fixed, and that's not just marketing language, just to be sure you understand, everything is capacity constrained ultimately when you're trading intraday only. So these programs will be capped, maybe without a whole lot of notice, as well, and we will roll out new programs, hopefully in their place.
All right. Next question. Have you back tested low vol markets to see how the programs would perform?
Yes, absolutely. We've traded through low vol markets. Like look at 2017. It was an incredibly low vol market. And I will tell you, we struggled in 2017. I can't remember the exact number. It was like plus or minus 1% for the year. It was a very frustrating year. When the market's not moving, so low volatility, that's the fuel that we live off of, and you can't make money, if it's not there to be had. So that is the one market environment that if we got back down to average daily ranges of say 10, 12, anything under 15 points is going to start being difficult for us to generate the kind of returns that we want to generate. Fortunately, the markets since 2017 have doubled since that time. So just a 1% move today is still twice as big as it was back then. So not really concerned about volatility anytime soon.
Yeah, and also you can think of different low volatility periods. And when you think about what 2018 was compared to what it is right now, I mean, 2018 was fairly low vol compared to what we're seeing now. And we still had great results in 2018 in our strategies. So as long as it's not like super just dead market, I think we're in pretty good shape. Next question. Your firm Series 3 not registered. Did I understand that correctly? What will that be the impact on us?
No impact for you. Series 3 just means that we took the test and passed it and went through the whole process of becoming registered with the NFA, National Futures Association, and the CFTC, and passed with flying colors and operated a registered entity managing other people's money for a couple of years with no complaints, issues whatsoever. We're just not registered anymore. So it's an issue. Some family offices have mandates, and certainly larger institutions have mandates that they can't put money with non-registered entities. But for our typical clientele, it's not an issue. And even we have quite a few family office types as well. It's not an issue.
All right. Next question from Gord. Is this available to Canadian residents? Yes. We can offer this to Canadian residents now. We do use a white labeled broker for that. So if you're a Canadian and interested, just email me, matt@investaquant.com or info@investaquant.com. There's really not much of a difference whatsoever between them and the Fox Group, but it is a white labeled version. So just let me know and we can get you set up there. Next question. How is the decision made to go from E-minis to using micros?
Some strategies will automatically switch over to micros in lieu of E-minis when the volatility becomes statistically excessive. So that is an automated, predetermined mathematical formula.
Yeah, and it's also important because if you just kept trading those E-minis and some of the programs, you won't pass the risk budget. As we looked at our risk management earlier on, every strategy has a certain risk amount that it can take. When you get into super high volatility environments, a lot of those strategies just would never be able to trade because they wouldn't pass that. Now we do get around some of that with some of our bigger programs. They don't need to go to the micros. But if you want to continue trading with some of the smaller programs, then you have to go to micros to be able to afford the daily risk. Next question coming from S. Trying to understand better when you say larger portfolio will have more diversification. So if I wanted to do 150K, you have the two programs running differently than the minimum investment.
Yes, so, I got it, Matt. So okay. In a nutshell, the smaller programs like Meta and Trader have fewer strategies trading in them. If you trade both of them, that's the combo. So it's the same group of strategies. If you go to Select has a whole group of a category of strategies that we call select strategies. They typically are our most capacity constrained. So they don't have the same capacity. And often they're in markets that are just less liquid than the ES, but still have plenty of opportunity and plenty of liquidity. And sometimes our number one moneymaker of all time was actually in the NASDAQ futures. And it's in the select program. So that's what we mean. They have more strategies that you're not going to find in the other ones, which over time will improve the Sharpe ratio and reduce volatility, give you better risk-adjusted returns.
All right. Next question. Do you have your own IT team? Yes. We have several developers here on staff. Next question for Meta. Does the 30K minimum account correspond to one contract trade size? Yes. Meta is trading a 1 ES contract position size per unit. So if you're putting in $30,000 to trade that program, it would be trading essentially 1 ES contract. There are a few scenarios where it gets really high volatility where it may start trading micros, but that is generally a 1 ES contract position. Here's another question from Alfred. You said the broker will review margin and you said you can add money to restore drawdown and typical account. Do you maintain a percentage for drawdown and reserve, or is it always 100% invested? The program it's never technically 100% invested. So it is trading positions using margin, day trading margin. So it doesn't take all of your money to trade a single position. So it's basically holding some money in there for your drawdown. Now, if you go into a drawdown and it gets deeper than expected, then that would mean there's potential that you would need to add money to bring it back up to where it needs to be to trade. But when you're starting with the recommended amount, we're telling you a recommended amount that has a nice cushion for drawdown that would be able to withstand at least the largest historical drawdown and a little bit more than that. So that's why we give you a good suggested funding level there.
Hey man, if you can just sort of power through these last ones, we've got about 3 minutes before it's 6 o'clock and I'm starting to worry.
What was the performance in March of 2020? March of 2020, most of our systems had very small results. There were risk management algorithms that kept a lot of those trades or a lot of those days from trading. We did not have the ability to trade micros at that time. So most of the systems just kind of shut down and went quiet then. And then when the volatility came back up and they could afford the daily risk, then they would start trading again. Go ahead.
If I may interrupt, just look at Trader 2's, look at the Trader program performance, and I'm not even sure it traded at all in March that year. So it turned off because of the excessive volatility. And that was done automatically. So that was pretty cool.
Yeah. There was very little trading activity at all that time. Okay. There's a bunch of repeat questions that keep showing up.
Question, do we get a margin call? I'm looking at them now just to help you out here, Matt, because it is a bit overwhelming. Do we get a margin call to top off the money if there's a loss? No. The suggested minimum funding we're suggesting is enough to cover not only a loss, but multiple losses and significant drawdown even. And you won't have to do anything. We're trying to make it as hands-free as possible for ourselves, which means for you as well.
All right.
Keep up the great work. Thank you. And I've been delighted with you guys and have referred many people to your company. Oh, thank you, John. You and the Fox Group have been very attentive when I was setting up my account. Yeah, those guys are great. They're a boutique that prides itself on customer service.
Next question from David. Would the growing total size number of contracts traded impact the future performance through slippage? David, that could theoretically happen. We stay on top of that. That is very important to us. And we will cap off our programs if that becomes a problem. But we've got some pretty sophisticated ways of executing to keep that at a minimum. So that's not been an issue, and we will stay ahead of that.
Another question from Anonymous says, I understand IQ Select may be the most limited in terms of taking new clients based upon the $10 million AUM capacity constraint. Any threat of it being closed soon? That is very hard to predict. I would say tentatively not soon, not in the coming months. In the coming year, I would think. The one risk I can't predict for you would be if a large whale came in and just took a bunch of capacity, and that's certainly a possibility. But as honest as I can answer that question. Next question was, end of day statement would always show a cash balance, whether above par or below, depending on the day. Correct. No open positions end of day, right? Correct. You'll have the cash balance relative to exactly where your balance is from where it started, plus or minus any gains or losses, and all fees, etc. And there are never positions at the end of the day. So it's always sitting in cash overnight. Jeff says, I second that. IQ's been great to work with, a longtime customer. Thank you, guys. Appreciate the nice words.
Will we get a recording? Yes, recording will be out tomorrow.
And Rick V says, 1 week to open and fund an IRA rollover through Midland to Fox. Incredible. I'm telling you, my parents literally sent me an email yesterday about some guy from Midland that helped them out. So I hear rave reviews, and I'm probably going to switch myself. So yeah, we hear that frequently. Any other questions there, Matt? I think we're getting close here.
Yeah, I think that's all we have time for now. It's 6 o'clock.
Okay. Folks, thank you all very, very much. Join us next Wednesday if you'd like to learn more about performance of the programs, the configuration of the programs, what makes them different, what makes them tick. We'll be all in on that, as well as brokerage discussions and getting started. And you can hear firsthand just how experienced that our execution broker is. Like I said, we're not for everyone. We wish you all well regardless, though. If you think we might be a good fit for you, join us next week. Or if you've been one of those people hanging out at webinars and are ready to go and get started for next year, do sign up. You can read frequently asked questions about getting started, as well as get started, see pricing and so on, using that link at the bottom of the slide there, investaquant.com/getting started. And I will tell you, based upon performance, has been really good, outstanding in some of our programs, outperforming historical norms. We are going to raise prices in some of the programs. I don't know if we'll have details next week or not, but certainly we'll share whatever we know, and that'll be effective at the beginning of the year. So if you're on the thinking about getting started, December is a good time. And with that, thank you all. Matt, great job as always. Appreciate everyone's patience. Sorry we went so long, but we covered a lot of great content, a lot of great questions, and everyone should take care. We'll see you.